Welcome to Real Estate is Taxing, where we talk about all things real estate tax and break down complex concepts into understandable, entertaining tax topics. My name is Natalie Kolodij. I'm your host, and I am so excited that you've decided to join me. Hello, everyone. We have just made it past the first fall extension deadline. Any 1065 partnerships or 1120S S-corporations were due on September 16th this year, so we've just passed that hurdle. And part of what I realized this year is that there are a lot of people who don't know they've created an entity. They're not aware that they have a partnership. I've talked about this before. Or there are people who create the entity, they create a partnership, or they create an S-corporation, but they don't really know, or their tax professional didn't give them a good rundown on what the difference is, on what is required for filing, on what will be different because you now have this. So if you are someone who has a partnership or an S-corporation and you do not have formal bookkeeping, you don't have full QuickBooks, you don't have a bookkeeper, then this episode is for you. So I will note, if you are using Tessa for your rental properties and you have a partnership, this is not formal bookkeeping. It's not a true bookkeeping, a true double entry platform. So while Tessa is great for keeping track of a profit and loss, of just keeping track of your income and your expenses for a property, once you move into a separate tax return, once you move into a 1065 partnership filing, there's more information we need to keep track of, and Tessa doesn't do this very well. So for today's show, I'm going to just talk through some of the differences, like why we need more information for these returns, and what information you guys should start gathering now to help prepare for the upcoming filing for the 2024 tax year. So I'm trying to give you a little bit of a head start. It's Q4, so you have time to either find and hire a good bookkeeper to help you get books before the end of the year, or time to start gathering all of the information I'm going to talk about so that you have a jump on all of the information your accountant is going to need. If you go to a tax professional and they're not asking for all of this information, while they might technically be doing your tax return, they're doing it in the most surface level, numbers on forms way possible. We'll kind of talk about that a little bit more, but I recently had a new client who went to a large, well-known tax and attorney firm, and last year for their entity return where they didn't have full books, they just had the client complete an organizer. So they just used whatever information he told them, whatever amounts for bank account balances, etc. They did not ask for any of the actual documents to check any of this. And if that's the case, there's close to a 0% chance your return is accurate. So let's dive into it. Let's start off with what happens when you create a partnership or an S-corporation. The first thing that I want people to consider when they are creating a partnership or creating an S-corporation is this creates a whole new additional tax return. So there's a whole separate filing. And even though something might not have changed with your business, last year you might have had 2 rentals and they were on your personal return, and this year you have 2 rentals and now they're in a partnership, there's a whole additional filing, and entities require more information. There's more we have to track, there's more you have to do. So the first consideration I want you to be aware of, if this is going to be your first year with a partnership or an S-corp, is it's going to cost more money if you go somewhere to have your taxes done. Now, how much more it's going to cost, that I can't say for sure, because different firms, different locations, different levels of expertise or specialization is going to impact that pricing. But like with anything, there's going to be higher end and lower end and everything in between. The same way you can get a steak at an Applebee's for $8.99, or you can go to a Ruth's Chris and pay $89. It's across the board. The price point I most often see for entity preparation at better tax firms is going to be a minimum of $1,500 to $2,000 per return for just the filing. So keep that in mind when you're looking to create an entity or switch over to being a partnership or an S-corp, kind of pencil in that ballpark number into your mind as an additional cost. And that number tends to surprise people when they have multiple entities. I think because the big picture price point can add up really quickly and it's not expected. But if you look at one of the commonly well-known self-prepare softwares online, you can do your own entity return. It costs $800 for you to do it yourself with their software, or $1,750 for you to have one of their, quote, tax professionals do it for you. If it's going to cost you $800 just to do it yourself, if you're going to a firm and an expert is doing it for less than that, to me, that would be a little bit of a warning. I would just be a little cautious there. So now you're aware of the additional costs that can come into play for just the filing. What else might you run into? Well, the next consideration is that bookkeeping and tax preparation are typically separate engagements. So if you are expecting to give someone a pile of receipts and bank statements and all of that, and have them organize it into categories and make sure everything ties together, and then use that ending information of total costs for all of your different expense categories to then prepare a tax return, that is bookkeeping. So if they're starting with raw information that's not organized at all for the whole entire year, that's going to be an additional cost. That would be a whole separate cost. So be aware of that. So if you do not have formal bookkeeping, you don't have QuickBooks and a bookkeeper, at very least, you will want to make sure you have the following information together ahead of time for your tax professional, unless you are also intending to pay for bookkeeping. If you don't want to do that, you're going to want to listen on, because these are the bare minimum of what you should start organizing now. So the first consideration, which you should always have if you have a business or rentals, is a profit and loss. So no matter what kind of business, you should have a profit and loss. If you have rentals, this should be sorted by each property. We'll need to know total rents or total income for that property, and then a breakdown of all of the expenses by expense category. And for these categories, you can look at a Schedule E on the 1040 or an 8825 on a partnership return, and that will give you a good example for breakdowns. In addition to just having a profit and loss, another common question that comes up is repairs versus renovations. When does it get capitalized? You don't have to figure that out. That's what you're paying a tax professional to do. So you can put the total number into your repairs account. You can have that in there. And then when you give it to your tax professional, just make sure they have the details of what that number is composed of. So the next item is really the big difference that creates a lot of this extra tracking and information needed for a partnership or an S-corp, and that is a balance sheet. Your balance sheet is exactly what it sounds like. It has to be in balance, and it's a snapshot of everything at the end of the year. A balance sheet lists your assets, your liabilities, and your equity. And as long as these are all correct, your assets should equal the same amount as your liabilities and your equity. This is what makes it very hard to prepare one of these returns, a separate entity tax return, without actual bookkeeping. Because when we are trying to piece this together without formal bookkeeping, I can almost guarantee that that is not going to balance on the first try. Now, there are requirements for when an entity has to have a balance sheet. It is my preference and it is my belief that you should always have one, because it is that check system. It is what proves that this return is in balance and that it's correct. So it is a good practice to always have your balance sheet, even if you don't technically need it yet. The other reason is because you might cross that threshold to suddenly need it one year where you are required to have it. And with the information on the balance sheet, it's really something that is much easier to track on an ongoing basis than to try to recreate the entire history of in one year when it is now required to be done. So now that we've covered the big picture items related to these returns, it's going to cost you more. You're going to need to have accurate records, and you're going to need the information to create a balance sheet. Let's go into what that information is. What will you need, and what should you start thinking about now and getting information and creating a checklist now to know you have everything to provide your tax professional with in a few months to do your 2024 tax return. So again, a balance sheet is made up of assets, liabilities, and equity. Let's start with assets. For your assets, what we are going to need is a snapshot of all the asset amounts as of December 31st. If you have several different bank accounts for your partnership or your S-corp, you will need to provide your accountant with the year-end bank statements for each of those accounts. They need to know the total amount as of 12/31 that you have in any bank account. Now, a caveat to this is many bank statements do not end on the 31st. So if your December bank statement goes through December 23rd, and then your January bank statement technically has the information from December 24th on through January 23rd, you will need to give your tax professional December and January because they are going to need the information for all of December that's on the December statement, but then also those few days of transactions that could occur the last week of December but end up on the January statement. So they need to be able to create a tied out total of the amount that would have been in every bank account of that business as of December 31st. They are also going to need a balance for anything owed to you. So if your company loaned someone else money or sold something on financing, like an installment sale to a new owner that wasn't inventory or goods, anything of that nature where there's a loan that your company should be receiving payment of, that should be listed as an asset. There might also be some escrow amounts for items that you've basically prepaid in to your rentals. You prepaid to have an amount kind of in an account that your mortgage company is holding that they will then use to pay your insurance and taxes. You'll need that amount. So your accountant is going to need your year-end loan statements for any of your properties to be able to tie out those amounts. And then one of the common assets that you'll see on a balance sheet is going to be the real estate. So if you have rentals and they are in a partnership, they hopefully are not in an S corporation. That's a whole nother show. If you have rental properties, the year-end balance sheet will list the asset value. So that's going to be their starting basis and increased by any other renovations or things like that. And then it's also decreased by the amount of depreciation that has been taken up to that point. So all of those things tied together should create your year-end asset amount for a balance sheet. Moving to the lower half of the balance sheet of Schedule L, you will have your loan balances. It is important to note that the amount on your 1098 is not the year-end balance for your loan. So even if you gave your tax professional 1098s for your mortgage interest, that will likely not have the correct loan balance. So make sure they have a loan statement for each of your mortgages that go to each of your rentals that lists the amount as of December 31st. You will also need year-end amounts for any other loans that the company is liable for. So if you loaned your company money and it's documented on a formal note, it is recording interest and it's expected to pay you back, you have a shareholder loan or something like that, that would be listed as a liability. If you have credit card balances, that's also a liability. Similar thing here to the bank statements. Your tax professional will need to know the balance on any and all credit card accounts for that company as of December 31st. So they will need that year-end credit card statement. And if it straddles 2 months where the December statement ends on, say, December 23rd, they will need the December and January credit card statements. Also under your liabilities will be security deposits you're holding from your tenants. When you collect that security deposit and you just are holding it until the point they move out, at that point it is listed as a liability to you because you technically owe it back to them until they move out and it's sorted and you get squared up with any amounts you're keeping. So the year-end amount of security deposits you have as of December 31st, that needs to be listed as a liability, and that needs to be an amount that you provide your tax professional. And the final piece of the balance sheet is going to be our equity section. This is arguably the trickiest section because there's a lot of pieces that come into this that can be kind of mixed up or confused. Most of the assets and liabilities are amounts that we can pretty accurately confirm, right? We can look at a year-end statement. We know that is the amount of a loan, or we know that's how much is in the bank. But with equity, this is where you having this warning that you have Q4 here to start putting this information together, this is going to help you make sure your equity section is accurate. This section of the balance sheet ties together a few different things. It is going to be the net amount of your net income or net loss for the year. It's also increased by contributions during the year, as in money you have put into the business, and it's reduced by any money you took out of the business. Make sure you have a running tally of literally any money yourself or any of the other partners, etc., or shareholders if you're an S-corp, any amounts you put into the company or any amounts you each had taken out of the company. Make sure you have a tally of that. This is often something that is constructively done. So what I mean is that pretty often what I will see with a partnership is where the partner doesn't actually put in money. They're not taking $5,000 of cash, putting it in the company bank account, and then paying for something, which is what you should do to help maintain that separation between yourself and your business. What we often see instead is a constructive amount, meaning that if you personally say you want to get a points bonus on a new credit card you have, so you decide to pay for that $5,000 renovation on your rental property using your personal credit card so that you can hit that points bonus. What that now means is you have made a contribution into the business. So without that information, your balance sheet wouldn't balance. If you had that $5,000 expense on your profit and loss, that is decreasing your income for the year. But we're missing the other part of it, which is how it was paid for. So if you ever pay for something that is an expense related to a property or related to that business, that entity, that partnership, or that S-corp, if you ever pay for that personally, either out of your bank account or on your credit card, or your parent pays for it for you as a gift, if anything other than one of the accounts that you've given your tax professional those year-end statements for, if the payment for an expense came from anywhere else, that is going to basically be considered a contribution. You put in money to the business from something you had outside of it, right? Whether it was literal cash or you paid for something on its behalf, that needs to be recorded as you contributing something, contributing funds of some constructive way into the business. And again, you shouldn't be doing it this way. People go through a lot of effort to set up these separate entities and LLCs for protection and this and that. And once you start intermixing in this way, it's basically piercing that veil, separating the two. So try not to do this. If you ever need the business to pay for something, but it doesn't have enough money in the account, you should put in the money to the business account and then let the business pay for it. But again, this often doesn't happen. So if at this point you're listening to this podcast and realize, oh crap, I have actually paid for several things this year on my personal credit card, or it was just easier to buy it all together on one transaction when I was at Costco, etc., make sure it is recorded as a contribution into the business. The same thing is true if the opposite happened. If you took money out of the business, right? You just withdrew $1,000 because you had, more than enough reserves in there and you wanted to access some of it. That's totally fine. That's not a taxable event most of the time. But your accountant needs to know that you took funds out of the business to yourself personally. They just need a record of that. Same thing if it was constructively done. If you decided to pay for your personal taxes out of your business account, we see this really often. If your business sends the IRS a check for your personal taxes, then that is a distribution to you. That's not a business expense. That's the same as the business giving you the $10,000 and then you using it to pay for your taxes or anything else. So anything that was paid for out of the business bank account or using a business credit card or just money you withdrew out of it, all of that needs to be listed as a distribution, as funds you removed from your partnership or from your S-corp. This is where the vast majority of business returns that do not have actual bookkeeping, this is where the mistakes are going to be, is people do not typically keep track of that money in and money out, especially if it's one of those creative ways. So again, this episode is your warning. You've got 3 months left till the end of the year. Go ahead now and start going back through your transactions for the year and putting together that transaction log of money you put in or money you took out. Same with any of the other partners or shareholders, any money anyone put in or that they took out, or anything you paid for the business is listed as money in. Anything the business paid for on your behalf is listed as money out. All of that is required for that balance sheet to balance. The last item to talk about related to an entity return and keeping an accurate balance sheet and what you can start keeping track of now to get you ahead of the game is if you are doing flips, things are going to be a little bit different. If you are a house flipper or you are a developer, you're building properties or renovating properties to resell them, a lot of the information related to this will be on your balance sheet until that property is sold. The purchase price of that property, all of the renovations that went into that property, all of the holding costs, those are all added together into an asset account on the balance sheet. It is effectively a piece of inventory to your business. If you have multiple flips going at once, each individual property should be listed as its own asset, and you should be keeping track of each one separately. So all of the costs that relate to your properties that are a flip or a construction, a new build, while it's in progress, those are all a balance sheet amount. Those are all listed as an asset on the balance sheet and are effectively inventory. Once that flip or that new build, once that is sold, that amount of inventory, that total of all the costs that went into it, that's when it moves off of your balance sheet. It gets zeroed out on the balance sheet, and that amount gets moved over to being a cost of goods sold. So then you have everything matched up. In the year the flip is sold, you have your profit, your gross sales price on this flip, and then you also record all of the costs against it. That's when it moves over to being expenses as a cost of goods sold. If you are someone who is doing new construction or flips, your tax professional will need the purchase documents for the properties you bought during the year. They're also going to need the purchase documents for any properties you sold during that year. And they will need to know the total amount of costs that went into that property during that year as well. So the total amount of renovations and holding costs for each property as separate amounts. All of that is going to go into your balance sheet. If you have a property that is purchased in one year and not sold until the next, that inventory amount carries over. It is on your balance sheet as ending inventory for the first year, and then it carries over to starting or beginning inventory for the next year. So if you are doing house flips and you do not have formal bookkeeping, you will need to be diligent about keeping track of each of your individual projects, each property and the purchases and the amounts that go into it for each year. That all has to be tracked specific to each property on an ongoing basis, and that's going to impact your balance sheet. At the end of the day, if you are someone who has a partnership or an S corporation, I strongly recommend having actual bookkeeping. At my firm, we require full bookkeeping for anyone who has one of these entities now. I know a lot of other firms do as well, but if you don't, and if it's not in the cards right now, this is what you are going to want to start getting together to be able to provide your tax professional with everything they need to do your 2024 taxes for that entity return. So again, the quick and dirty rundown is they are going to need a profit and loss, so all of your income and expenses for the year. If the entity has rentals, they'll need a breakdown by each rental. The tax professional is also going to need a summary of all of your assets and liabilities as of year end. So this means all of your bank statements that would show a December 31st amount. This might require December and January. And any amounts for new assets that you purchased, whether that is a new property, they should have the purchase documents. If you put in new renovations, they should have that total, etc. So the total amount for any new assets during the year needs to be added as well. For your liabilities, similar thing on this side, your tax professional will need the year-end balances for any loans and any credit card statements. The amount of the loan listed on your 1098 for your mortgage interest, that is not the amount they need. They will need the loan statement that shows the December 31st amount of the loan. That will likely also show your escrow account information as well. Credit card statements, same thing here. They need that December 31st amount. So it's likely you will need to give them both your December and your January credit card statements for all cards that relate to that entity. And you will also need to provide them with the amount of security deposits that you currently have at year end that you are holding from any of your tenants. Also, any other payables. So if your company owes you money or owes anyone else money, that needs to be listed on the balance sheet as of what that amount is for December 31st. Your accountant will need that amount as well. And then for the equity section, go back now and start creating a log of any money you or any of the other partners or shareholders. Create a log of any money that was put into the business during the year or withdrawn or taken out of the business. And this includes anything constructive, such as you personally paying out of your personal bank account for something that related to the business. If the business paid for something that is a personal expense to you, that is the same as you withdrawing funds from the business. So start going through and creating that running tally now of anything that you or anyone else who's in the company has put in or withdrawn either directly as funds or constructively through paying for on behalf of the business or vice versa. So I hope this helps you guys get a little bit of a head start or a little bit of a better understanding of what needs to happen if you now have a partnership or an S corporation for the current year. And I can't stress this enough. This is the time to start getting this information together. This is the time to start looking for a good bookkeeper. Waiting until tax season is not the time. As always, I hope you found some value in today's episode. And if you can think of someone you know who's started a new partnership or an S-corp this year and they seem a little bit lost in the sauce, please send this to them and hopefully it'll give them a little bit of clarity on at least what information they need to start getting together so that they're a little better prepared come tax season. So thank you guys again for listening. And if you have questions, please join us in the Facebook groups. I've got them linked below in the show notes. And as always, I will talk to you next week.